Yeah. Two. Yeah. Aye. I'm jacking the beat, you calling the cops. The yapping is cheap, I call you the ops. The rapping is hating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit. You tipping and hit up the cash app. Baby girl, been around for it, yeah. In the old days, I was stuck in old ways. Never really trying to flip the old page. Young man tripping at an old age. Thinking I was flicking, had a low wage. Led the bro days, then a slow praise. Thinking it'd be different, it would gon' change. Then it really didn't, it's a cold game, yeah. Ay, all I really wanted was the money in the pocket. Got over money, but the money ain't the topic. Like Bill Doe and the money gotta stop it. Kid need food and the whip need juice. I'ma get these views when the
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partners back in the saddle again, guys. Looking always better than you. Take that down picture for your mom and them guys, and welcome to another edition of the Real Estate Friday Training Clip. What's going on, baby? How you doing, big time? How was the week, man? Talk to people. What's going down?
Man, it was a good week, man, coming down to it. Man, just going up and down, but we trying to end it right.
We are trying to end it right, guys. And don't you worry on Instagram, guys. I got you, man. If we don't get this going on Instagram, it'll be live stream again here in a second. But don't you worry, man. Cliff, man, while we're doing this, big dog, while I'm taking care of technical issues, man, tell me what's going on with the market, man. Tell everybody what's going down with the market. First, before we do that, did we get the bag?
Oh man, yeah. We coming through with it, man. So it's looking good. But what's been going down with the market? What's happening?
Yeah.
Man, it's making a little bit of a rebound. We're starting to see, a little bit more action, but the mortgage prices are coming down, right? The interest rates, they coming down a little bit, but we're starting to see them level off. We had the inflation rate pop up a little bit. So I think we're going to stagnation right now. I think we're about to see everything just kind of stay where we is for a little bit.
Didn't I say? Didn't I tell y'all, man, that inflation rate gonna go back up, because you cannot continue to print money and think that you are just chilling, getting it in with the people, man. That's just not gonna happen at all, man. But Cliff, man, why do you think that the inflation rate went up? Why do you think it went up?
I think it's gonna moderate, right? I think it's not just gonna completely fall every time. If you look at the stock market, it never just goes straight up. It never goes straight down. It always moderates up, moderates down. So I still think we headed down. We just, it's 1 month, pops up. I still think we're gonna see it keep falling.
So my question is, why did it pop up?
I mean, you could have changes in I think the main one is prices, or the pricing in housing and rentals. So those take a while to roll over. So we may see a little bit of time for that. I mean, it's we've had what, I think 7 months straight, or 6 months straight of seeing the inflation rate fall. So I mean, it wouldn't be crazy to see some moderation in there.
Sure. I can see that as well. Now, do you think that the Fed is going to pause, or is the Fed going to lower, or they're going to raise it again? What are you thinking?
Oh, I think they're gonna pause.
Why do you think they're going to pause?
Man, because there's nothing definitive yet. Nothing definitive yet. I think they need to stay at this rate for a little bit, get some feedback,
Yeah.
because this will be what? I think this will be 3 or 4 straight months of it being at paused. So we're gonna get feedback. We're seeing the market tighten more. There's
Okay.
this, so they're seeing different stuff is still prices. Stuff is still going up a little bit. We're seeing some moderation in the market, like I keep saying. So I think they're looking at that and they deciding when. When do we jump back in? When do things get bad enough that it's time to cut?
Mm, Hey, Cliff, for the folk in the back row, didn't I say, didn't I say that this was going to happen?
What's that?
That inflation is going to continue to go up because they're going to continue
Mm,
to print this money, right? Which is going to cause for a conflict of when of the Fed having to make a move because if inflation is going up, now what?
mm.
Am I right or am I wrong?
No, you right, but it's inflation went up for 1 month.
Ah, so now we're looking at not. So now what's happening is we change the calculations from every other year to then every year. Now it's every month. Now is it gonna be? Now it's gonna be every week next, every day next. What's the
Nah, I think.
standard?
I mean, how much did it go up? How much did it go up?
That calculation I don't know off the top of my head. I don't know that off the top of my head. I don't know that one.
Okay, yeah, because I'm thinking that I think it barely popped back up. Um, and we coming off these numbers are for Christmas too over December. So I mean, you can see a bump in that
Ah,
for December. So that could what I mean
ah,
that could explain it a little bit. You have additional purchases, additional demand coming in December. So
ah. Okay. So now because we were in Christmas and holidays, and people didn't spend as much money as they normally spend on Christmas. I wonder why. Because it's some kind of inflation. And then the very same thing, what was caused the constraint of spending. Now what has happened is we go into January and now the inflation rate is up, caused by the same situation that caused people not to spend a lot of money in Christmas. Am I right or am I wrong?
yeah, I mean it's
Okay.
right now, anytime we have demand, it's gonna pop up. But
Oh
I
yeah.
mean, I don't. What I think is, I don't think we're gonna hit the 2%.
I don't hit 2%. Okay. Oh,
No.
that was never the case. That was
Mm-mm.
a pipe dream. That was a salesman pitch. Well, that's all it was. Our thing. Our goal is 2 to 3% inflation. BS. You knew that wasn't gonna happen. You knew it. The only way that's gonna happen is if you begin to massage the calculations again, which is not uncommon at all.
Yeah,
Am
yeah.
I right or wrong?
No, you're right. Because even in their verbiage, right, what the Fed is actually saying is they said over time. They said 2%
Yeah.
over time. Now,
Overtime.
what time? They don't say.
Of
They
course.
just say
Of
over
course.
time.
I'm smelling some bullshit. I'm smelling some bullshit. I'm smelling some bull. I'm smelling some bull, man. Don't believe nothing they tell you. Yo, it doesn't matter how many times you massage the numbers. You have terms and definitions. You can't violate the term definitions. Now they're trying to change the definitions, the definitions of the terms now. Transitory. That word made up. Come on, stop the cap. All right. But guys, man, now Cliff, real quick for the folk in the back row, what are you seeing in the market from $300,000 and below, 350 and above to about 1 million and 1 million plus? What are you seeing in those three price metrics?
Same thing. Anything below 300,000 is strong. People
Mm,
are still buying. I'm seeing still, not the we. I don't know if we ever gonna see them days on market that we saw in 19, 20, 21. Them
really?
we especially here in Dallas, we saw at that time I was seeing 10 days on market,
Yeah. Yeah. We
15
were.
days on market.
We
No,
were.
them days passed. In the
Them days
market
is
we're in right
gone.
now, it's starting to see, 30 days, 45 days. I saw one that was 65 days for property 400,000.
Wow.
For I think it was 465.
Wow. Wow. That's crazy town. Guys, it's getting real out there. It's getting real. It's getting real.
Yeah.
It's getting real. It's getting real. But Cliff, man, let's go ahead and jump into this thing, man. And guys, we do have a new sponsor as well. We got a sponsor, Cliff. We got a sponsor. But at the end of the show, guys, I'll play the sponsorship, guys. I don't have a problem with it at all. But guys, let's jump into what's the topic today. Cliff, there was a report that came out that from MasterCard, right? MasterCard, that credit card delinquencies have spiked. Spiked. And this is after, during and after, right? Before, during, and after the holidays. So it's not due to holiday spending, because the holiday spending was constrained because of inflation, right? What we're seeing right now is you're seeing a lot of the exact same time. You're seeing that MasterCard is saying it spiked and the spending has slowed down. That's what it's slowed down. So we're gonna listen to our guy real fast, and we're gonna comment on the guys. But look at what he talks about on this, man. And Cliff, tell me what you think about it, man. We can kind of go from there. Let me make this thing a little smaller, man. I mean, there we go. Bro, we can't see. There we go. There we go. All right, there we go. My man's in there. My bad, y'all. My bad. All right. Cliff, let's get to it. There we go.
Credit card companies like MasterCard and Visa are reporting a big slowdown in consumer spending, something that suggests the economy in the US is not as healthy as people think. With MasterCard reporting that US retail sales grew by 3.1% this holiday season.
Okay.
However, that growth was not adjusted for inflation. After you just
Whoa, we got to pause right there. We got to pause right there. So you mean to tell me, Cliff, what I'm hearing these fools say is they bragged about a 3.1% uptick, right, when it comes to consumer spending in the holiday season. But those damn numbers did not adjust for inflation. Am I tripping?
No, I would think. So this is giving they basically just giving you the raw numbers. They ain't adjusting. Okay.
Right. Trash. Garbage, man. You can't garbage. Come on now. I'm smelling some bull. I'm trying to tell y'all, man. I'm trying to tell y'all. We keep seeing people sacrifice terms, definitions, and it's getting y'all in trouble. Y'all in trouble. Let's keep going, Cliff. Am I tripping, Doc? Am I tripping them off? Let me know.
No, I gotta see where he's going with this.
Let's go.
Just for inflation, there was actually no growth in retail sales this holiday season. It was actually the worst performing holiday sales season going all the way back to 2017. Which is going to be a big concern for the state of the U.S. economy here in 2024, because over 70% of U.S. GDP comes from consumer spending. And so if consumers are cutting back on spending and there's a slowdown in spending, that suggests the economy might finally enter the recession that everyone has been predicted. Because it's not only MasterCard that's reporting this slowdown, it's also Visa. Each month, Visa releases a report called the U.S. Spending Momentum Index, which is an index scored from 0 to 100, with values above 100 indicating acceleration in economic momentum, with values below 100 indicating a contraction. And what's a big concern here is if we scroll down this list to late 2023, we can see 94.7 on the spending momentum indicator from Visa, which is well into contraction territory. It's actually one of the lowest values that we've seen going all the way back to 2014. And I think what's going on here, everyone, is that the U.S. consumer has finally had it here in early 2024. The consumer is running out of money and they're running out of patience because 2+ years of inflation combined with now decades high interest rates have created a situation where people can no longer afford to sustain their spending and lifestyle, and thus people are having to cut back. And this cutting back, I believe it's going to continue to occur throughout 2024 because there's a lot of stress mounting under the surface here for American consumers. When we look at this credit card data, we're seeing more and more people slip into delinquency and default, meaning that they can no longer afford to make the payments on their credit card. With the Federal Reserve Bank of New York reporting in their household debit and credit report a big uptick in 30-day delinquencies For credit cards, everyone, take a look at this. Under credit cards, the blue line, you can see the 30-day
Look at this.
delinquency rate plummeted in the initial stages of the pandemic when the government handed out all those stimulus.
Cliff, look at the student loan, man. Hold on, look at the student loan, bruh.
Oh,
Look at the student loan. God
yeah.
damn.
When you ain't got to pay,
God.
there ain't no delinquencies if you don't have to pay.
Wow. Look at this, man. Auto loans. Look at this. Auto loans is higher than credit card debt. No, I'm sorry. It's just briefly lower. Look at this. Look at this. So look at people are not paying at all, Cliff, right? At all concerning the student loan. So there's no delinquencies. But look at the credit card debt and the car payment debt. But I told y'all. Let's keep going. We ain't done.
Well, I mean, if you
Stimulus checks,
look
but
at it though,
Yeah.
look. If you look, it's up. That's because it was down before, so it's up from what it was previously. But if you take, let's see where it was, it's actually flat from before the dip.
Which one are you talking about? Credit card or auto?
I'm looking at auto.
Okay. Gotcha. Yeah,
see what I'm saying?
it is going flat. It is going flat there as well. So it dipped down. I guess people were not making any payments at all, or what it may be, and then all of a sudden it went up.
Right, there was no auto sales because remember there was no autos to sell during the pandemic because of the supply chain. Once they came back, it rebounded to its normal level.
So what was the reason why there were no auto sales?
The supply chain. There wasn't. Remember back during the pandemic, there was no cars on the lot.
That's correct.
So there can't be delinquencies if there's no cars to sell.
You're right, and also you got to look at people. There was a big old push for EVs, and those both they ain't selling at all. EVs ain't selling at all. It's like they have 2025, 2024, and 2024 and 2025 models out, and they're not selling even with the subsidies. People saying we don't want them. We don't want them. That's crazy, Tom. Let's keep going, Clip.
But since then, the transition to 30-day delinquencies on credit cards has spiked up to 8% of credit card loan balances, which is now the highest 30-day delinquency rate since 2011. And unfortunately, it's not only 30-day delinquencies, it's also 90-day delinquencies. We're also seeing increased credit cards. You can see 90-day delinquencies are almost up to 10%, which is data that comes from the New York Fed Consumer Credit Panel and Equifax, which is a concerning signal, everyone, because there's over $1 trillion in aggregate credit card debt in America. That's right, folks, $1 trillion in credit card debts. And so if we see the default rate on this credit card debt continue to increase, we're going to see problems in the economy. Because if people are defaulting on their credit cards, that means they're not going to be able to spend as much money. They're not going to be able to expand their spending. And more concerningly, it's also just like a warning indicator for the health of consumers overall. You can bet if the credit card defaults are going up, we're also going to see the auto loan defaults go up and the mortgage defaults go up. And what's really shocking and disturbing to me, everyone, is that when I look around and I see the reporting from a lot of mainstream financial news entities, a lot of them are not talking about this. And not only are they not talking about this, they're looking at the same data I'm showing you and coming to a completely different conclusion that's much more optimistic about the state of the economy.
Which leads me to conclude, Cliff, they selling, Cliff. They're selling some bull. They're selling some bull. They're saying, Cliff, that's not pee. That's rain. Yeah, am I tripping?
If you look back to what I said, if y'all go back and look, I said the first quarter is going to be bad because that's what's going to force the Fed to cut.
Okay.
Because we're as tight in the by the Fed standards as we're gonna get.
I agree.
So we're holding.
Yeah.
And it's like, how long can you hold at these high interest rates? inflation is high, interest rates are high, and there's no money moving through the system. There's still quantitative tightening, which means they are selling. They are selling assets through the Fed, which is pulling money out of the system.
So what I'm hearing you saying is the Fed is originating bonds and T-bills, delivering it to the Treasury, and then the Fed is expanding their balance sheet by buying the exact same T-bills and bonds that they originated.
Exactly. So then, what we're going to see is that has to reverse at some point. If we held here at all these standards, how long? You already showed you credit card debt. What you think?
Wow. I want y'all to hear what he just said. The Federal Reserve, they're originating T-bills, Treasury bills, and Treasury bonds, taking it over to the Treasury. The Treasury then buys it from the Fed, right? Via check. And then the Fed turns around and buys the exact same T-bills and bonds that they originated. Huh? That is what business model survives that?
Yeah, when you could print your own money, you can do about anything.
Wow. Let that sink in, y'all. Let that sink in real quickly here, man. Let that sink in, Cliff. That is wow. But anyways, Cliff, man, what you got to say real quickly about what he's talking about concerning these credit card delinquencies? Why is it happening? Number one, and then number two, I'm gonna let you go on for a little bit as well. What's causing it, and how can it be reversed? Go ahead.
Yeah, I mean that's a bad number. That's a good indicator of what's happening within the market right now. Anytime you have credit card bills going high, it's like the interest rate's already 25%. It's hard to pay them back. Plus, you're not earning enough to be able to pay them back. So you're paying the minimum, and that's just increasing your credit card debt even more. And the reason for that is we're just not seeing the money flow into the system. The reason for that is because the Federal Reserve is making sure that the economy is tight. Inflation's up. You go get something to eat. You already seeing prices go way high, right? You go to buy. Even look at McDonald's. They prices is up. But at the same time, you're like, okay, well, maybe you can make up for them high prices if you earned more. Like, well, I mean,
Correct.
I'm making a lot more money. I can afford it.
Mhm.
You can't make more if your business can't make more because the customers are broke.
So, how do you
Customers are
solve the
broke.
problem?
Cut interest rates.
Well, now, what is that? How is cutting interest rates going to solve the problem?
It introduces more liquidity into the system.
But isn't
Because
the problem there's too much liquidity in the system now?
no, the problem is that there's not enough liquidity in the system. That's why they tightened the interest rates.
But they're tightening that wouldn't in because in the reason why the Fed is tightening the interest rates is because there's too much excess cash, there's too much currency flowing to too few goods. That's what the definition of inflation is.
Yeah, exactly. So you have inflation, right? That increase the
Mhm.
cost of goods. Then
Yeah.
you
Yeah.
increase the interest rates so that those goods are too expensive to buy, right? That
Yes.
car, that house is too expensive because it's already up 20%. Plus
Yes.
the interest rate is high. You
Yes.
cannot sustain those levels.
I agree.
So at
I
some
agree.
point, once the inflation rate levels out, you have to cut in order to try to get that liquidity back into the system, try to get some money moving. And you can do that with quantitative easing, which is instead of them selling, they're going to start buying,
By
which is
what?
going to they're going to start mortgage-backed securities. They're going to buy a number of other bonds and start
Where does the
introducing more
money come
money.
from?
Oh, it's
Now you
printed.
said that. There we go. There we go.
Yeah, it's printed.
So the very thing that actually caused the problem, you're going to do more of, and that's going to solve the problem because what you're going to do is you're going to cut the rate so the money can begin to flow. But you're introducing additional fake cash into the system to solve too much excess cash in the system. How does that make sense?
Yeah, because we've always done that. We did that in
I
2009,
know.
10, 11. You know what I'm
I
saying?
know.
Up till now. So that we're going to print forever. We're
I,
never going to stop printing.
I know we're going to figure out. I know that what I'm trying to pinpoint is what's causing the inflation. It's too much fake currency flowing to too few goods. So what I'm saying is, how does
Mhm.
printing more money, right? How does that? I know we can't stop, but how does that solve the problem of what if you're using the exact same mechanisms, which is printing more money, that caused the problem?
Nah, because it's in order. First, we had inflation.
Okay, go on.
To stop inflation, we
Yeah,
raise interest rates.
raise interest rates. Yeah.
Until when? Until inflation is low. So now that solved problem number one. Inflation's now low. Now you can start printing not as much as you did to cause the inflation, but you can print a little more to sustain your 2-3% interest your inflation rate level.
I see what you're talking about. I see one problem with that whole situation, the printing aspect of it,
Mm,
because the printing got us into the problem. That's what inflation is. If inflation is when you, this is kind of like a balloon. When you blow up a balloon because there's excess air in it, it blows up. That's called inflation. You're inflating the balloon.
right.
So you're putting more cash into a system which is inflating the balloon. So how do you begin to deflate the balloon? Stop blowing in the balloon and let it out. Let the air out. Now,
But
what I mean, what does it look like
mm,
fiscally then? Stop printing. I agree with you. Cutting the rate so that currency can flow. The root word of currency is current, like the current of water flowing. Allow for the natural flow of currency, right? The consumer finding value in a product or service and exchanging currency for that service or product. That's the natural organic flow of this economy. What I see is what you're talking about. That's going to cause more of a problem because you are using the same currency, i.e., helium, like you blow up a balloon, to try to fix the problem. That's asinine.
it- it's man, it's all about degree. A little rain,
Degree.
a little rain ain't bad. A lot can kill you. You know what I
So,
mean? So it's all about degree.
so a lot of rain got us in this. So we're going to say we're going to keep it raining, y'all, but we're going to slow the rain down.
The if it was raining before, then it rained a lot. Then we stopped the rain. Then we're
Yes.
going back to it raining as it always has.
This is where me and Cliff
Yeah.
disagree. I understand what Cliff is saying, that's exactly what they're going to do. Is because it's a modern monetary theory.
Yeah, we
They
stuck
believe
in it.
they can print their way out of it. And let me give you some facts. Every fiat currency, is what we actually has tried this and they have a 100% failure rate. Every currency in the history of mankind. So this is not my theory. These are facts. Facts. This will fail. It will, because you cannot print your way out of inflation. Because printing is what got you into inflation.
Yeah, the thing that's gonna cause the biggest issue is the financing of the debt.
Yes.
That's what's gonna kill us. Is the fact that when we hit a point where it costs more to pay the debt than it
Mhm.
does for Social Security,
Mhm.
you a problem.
Because right now, the interest on the debt is over $1.4 trillion. That's more than the Department of Defense's budget.
Right.
That's not sustainable, guys. It's not. But hey, I digress. I
Yeah.
digress.
But that we stuck in it. We can't. There's the problem is that there is more debt in the system than there are dollars because we
I agree.
inflated. So
I agree. We
we
stuck.
stuck. We
We
have to
stuck.
print until something breaks, and then this is what I think was going to happen. They are going to refinance the debt. There's going to
With
be a modification.
Of course, the modification is going to be into a digital dollar. That's all it is. They're going to inflate it away by graduating over to a crypto/digital type of dollar. And in that scenario, they really believe that they can control inflation by going to the digital dollar. That's what's going to happen.
And they've already let you know how. They said, how are we going to lower the debt? How are we going to take care of that problem? And they said it. They said, well, because we don't see any cuts. One side had said there's no real cuts to lower how much money we're spending. So
Yeah.
how are you able to pay off that debt? And they said, we're going to enforce the laws on the books in terms of taxes, which means they coming after you. Taxes have to go up, period.
So you're getting two type of taxes. Inflation is a silent tax, and then taxes on the books. Get ready. Why do you think they've actually funded 87,000 IRS agents? It was not for the rich. It's for you. They're coming. That dude says 70% of the GDP of America is consumer spending. Who does the bulk of that spending? The middle class. They coming. They coming. But hey, y'all. Hey, I digress. So, Cliff, what deals are coming? I believe what deals are coming, man, are creative financing deals. Because of the fact that whenever you have a heightened credit card debt, which is going to infuse heightened payments, and you see the default because people can't pay them at all, period. The spending slowed down. People are going to begin making choices on how to go to a smaller house. The big house is probably gone if you don't have enough cash flow coming in from a business or job. Do you agree or disagree?
Man, I think there could be some options like that with people who can't sell the property.
Yeah.
And they stuck underwater.
Yeah.
But I think we're going to see a shortage. I think we're already seeing it. I think that's going to be the only way out of it is to cut interest rates because we have 70% of the market either has a house paid off or a mortgage rate below 4%, which tells me half those they'll never sell.
It's not so much selling as can you sustain the payment?
If they can't afford that payment, they can't afford any payment.
I'm rocking with you. That's why a lot of them are maybe saying it's time to downsize. It may go from a 422 down to a 322 or 311.
But see, I would agree with you, but so this is where we get them differences, boy.
Okay.
Here's the problem: if you own, let's say you bought your house in 2005, 200 grand.
Yeah,
that property today is 400,000.
Correct.
So even if you downsize, you're still going to buy a $300,000 property with an interest rate that's above the current one you're in.
Here's how contexts are different. I'm not talking about buying. I'm talking about going down to leasing, because a leasing rate is cheaper than you buying a property now. So I agree with you. Then they're gonna graduate over to a higher rate.
I feel you, but why? Why is it cheaper to rent right now than it is to buy?
Why is that?
Because all the loans that were at 3% and 4% are still in the market. They make up 70% of the marketplace.
I agree.
So that's what they could artificially keep the rental rates low because they don't need to pay an 8% interest rate.
Yeah, I see that. But what I'm saying is a lot of those homeowners may be saying, hey, I need to turn my property into an income producing asset. I'll move out to go lease and lease my property out because I need more money coming in.
I see what you're saying. They're going to get squeezed and they have to move on from that property because even though the payment is low, they don't have income.
There it is.
Got you.
That's why I say creative financing is in place. That's why, guys, I believe probably one of the most popular unknown strategies on the market is seller financing. Moving forward, I think that's going to become one of the most popular financing tools on the planet because it gives the power back to the consumer. and the consumer can begin to potentially, even if, depending on the rate, compete with their banking competition. Think about it, Cliff.
Mm-hmm.
If you had an option to buying a property with bank financing of 7% versus buying the same property via the seller for 5%, which one would you do via seller finance? Which one would you do?
Oh yeah, give me that 5%.
All day long. I believe what's going to happen is because I believe Congress is not going to stop printing. They, as you said, they cannot. They cannot at all. Period. Smoke and mirrors game is going to have to stop. I mean, it's going to get bad. That's going to give an opportunity for those that are wise to acquire properties below wholesale. If you're buying cash, right, increase the value, and then sell or finance that property out. What that means is you become the bank to somebody else. Cliff, what's the down payment amount for seller financing typically?
10%.
10%. Let's walk these numbers real fast for the people in the back row. Let me go here. Walk these numbers, Cliff, and you let me know if I'm off, man. Let me know. I am not above reproach, guy. Here we go. You know me in my calculators. I love my calculators. Here we go. All right, let's get rid of this real fast. So, Cliff, here we go. Can I make it a little bigger for everybody? Let me check. Nah. Well, that's fine. All right, Cliff, here we go, Cliff. We have, let's use, again, I'm using simple numbers, $100,000. Okay, Cliff, $100,000. And yeah, guys, this is not an amortization calculator. This is I can calculate simple interest here. $100,000, Cliff, 10% down is normally what it is, right?
Right.
So 10%, we know this, you know what it is, it's $10,000. So if you sell or finance the property out, guys, what actually happens is this here. Is typically someone has to bring a down payment to the situation. Well, since you're the bank, they bring it to you. So $100,000, right? Minus $10,000, the promissory notice for what? $98,000. Here is where I think the competition is going to begin to happen. Is Cliff? I'm using, yeah, guys, this is simple interest. But when it comes to seller finance, you get paid compound interest. Am I right, Cliff?
Right. Yeah.
So 90,000. Let's say, what's the rate right now when it comes to on the market? What's the rate?
Right now, it's hovering around 6.5.
So 6.5. Okay, cool. You know what I'm gonna do, Cliff? I'm gonna do something a little bit more special. I'm gonna actually use a mortgage calculator. Give me 1 second here, guys. I want to be as accurate as possible. Here we go. Yes, sir. For the folk in the back row, we got y'all. Yeah. Share. Boom. Here we go. All right, Cliff. Here we go, guys. This is the mortgage calculator, right? Mortgage calculator. Loan amount, 90,000, right? Boom,
Right.
90,000. 30-year fixed. What's the rate, Cliff? Is it 7.8% is the rate? What is it?
Well, let's say 6.8.
6.8. 6.8 is 6.8. All right. Boom. 6.8 is the rate. It says the monthly payment is $587. That's the monthly payment right now, right?
Right.
Here we go. Now let's say, for instance, someone is selling that same property, guys, right? Which is cool. Same property, but you got quoted 6.8. They're saying, hey, how about we do a seller finance transaction? You bring me 10% down, right? And I'll give you a rate of, let's say, and let's just say their rate is what? 3%? I give you a rate of 5%. Come on now. 5%. So 5%. So it went from 587 to 483. That's not bad as a Cliff.
Nah, you make it, $100 difference.
$100. So it's $100 difference, guys. So you're actually saving $1,200 annually, right? But the key thing is the amount of components that you're paying less. What I'm saying is, because I believe that it's going to get tighter, guys. What I'm saying is this here. It's going to get tighter. What I'm saying is, because it's going to get tighter, that option is going to be on the table. A seller could actually become the bank to somebody else and compete on the interest rate with a bank. Does that mean you got to bring more money to the table? Yes, it does. It sure does. But at the exact same time, guys, if you have 10% to put down, guys, be honest, even if you put down 5%, you're still paying less than if you did 3.5%, right? FHA or 5%. You can match a dollar for dollar. 5% on a FHA, 5% on seller finance. Your rate is 5% on the seller finance versus 6.8%. You're still winning. Am I right, Cliff? Or am I wrong?
Oh yeah. I mean, you saving money.
You're saving money. What I'm saying is this here. Now, by doing this, guys, as an investor, guys, and I ended with this, by doing this, guys, as an investor, what normally happens is you actually begin making a little bit more money. You begin building your wealth a lot faster. So real quickly, guys. All right. And I'm just going to use this here. Boom. Here we go. All right, Cliff, here we go. Oh, come on now. Here we go. So let's say, for instance, Cliff, you do one seller finance deal per quarter, right? And $100,000 is the sales price. And they're putting down 10% down. So, Cliff, $10,000 times 4, because it's 4 quarters, you're making $40,000 annually. Did you kind of replace someone's income doing that?
Oh yeah, all day.
And let's say, for instance, the difference there is you're making $100 a month, right? Per property, $100 a month times 4, it's $400 a month times 12. Boom. That's $4,800 on an annual basis. Makes sense? Divide that by 12, guys. You're making $400 a month. That's somebody's car payment, right? Remember, Cliff, they put down 10%. So remember, this is an equity gain too. So now you have 4 properties that you have 10% equity in. So 10% equity, you have $10,000 of equity in there times 4. So now you actually have grown your net worth by $40,000 as well. So you put 40 grand in the bank, right? You grew your net worth by $40,000, right? Which is great. But the exact same time what's actually happening also is you added $400 a month to your bottom line. That's not a bad deal, is it, Cliff?
Nah, man, you're making money.
Guys, you are making money. I want to keep it simple as possible because seller finance can get really complex. But that is the power of seller finance, guys. You increase what I call your commissionable income, your earned income and down payments. You increase your passive income and monthly payments coming to you. And you also increase your net worth at the exact same time, all 3 at the exact same time. Sick deal. Cliff, how much money do you normally make? How much money have you made on the seller finance deal before?
Man, you're talking about just like a lump sum up front.
Yep. Mm-hmm.
I did one. I think it was close to 20 grand, about 20 grand up front.
What was the sales price?
180.
So that means the principal note was what, 160, right?
Right. Yeah.
Well, what was your debt service interest rate?
Man, that one was like 135, something like that. And interest rate was like 5%, 5.75.
So you owed 135 and you paid 5.5% interest rate. Jesus.
Right.
How much rate did you actually charge?
9.
Mm-hmm. So 160, Cliff, you were charging 9% interest rate. Mm-hmm. Your debt service was on 135 and you were paying 5.5%.
Right.
How much cash flow were you bringing in approximately on a monthly basis?
I think it was close to 300.
That's something one like deal.
That. Yeah.
That's one deal. That's one deal.
Now they ended up refining out, but it still works.
It is what it is. It is what it is. You straight. You good. So, Cliff, that was a pretty good deal, wasn't it, man?
Oh yeah, man. I wish I had that one again, man. So that was an amazing deal.
So, guys, seller financing, guys, is a good, slick way. It can get a little complex, so you need to have good wise counsel around you. but it could be a very good way for you to build wealth, earned income, which is I call commissional income, and cash flow. Cliff, man, you want to say anything, man, before we get off, man?
No, man, just the same thing I say all the time, man. Just to get that one deal to get you started, because you'll be amazed what you can do with that one. Because then you figure out all the ins and outs, and then you on to two.
Yes, sir, man. Well, Cliff, man, that's all I have for today, man, guys. Hey, guys, we have a sponsor. You know what I'm talking about? And we're gonna play them right now before we end, and then we'll end from here. All right, here we go. This is American Rounds. Here we go.
Majors, I'm the CEO of American Rounds. We are in Pell City, Alabama at Fresh Value grocery store installing the first ever automated retail machine for ammunition. The stores were really the inspiration for it. I mean, they knew their customer base and they came to us and thought this would be a really good opportunity for their customer base. There's a lot of hunting community here in Pell City and thought that their customers would love an opportunity to be able to buy ammunition here at the store.
We're super excited to offer, what we think is the first ammo kiosk. We're always looking for ways to give our customer another reason to come visit our stores. Anything that we can do to help them make their shopping trips easier based on the feedback that we've gotten just from customers today. They are so excited about us having the ammo kiosk.
We're getting ammo!
One of the ways we're changing the landscape of ammunition sales is to make it more available. Being able to move into a place like a grocery store, supermarket makes it a lot more available to the public. But we're taking a different approach to it. Traditionally, ammunition is sold at outdoor type stores, your sporting goods stores, and it just sits on a shelf. It's very accessible. Because of that, there's a high rate of theft. But with our machines, as you can see here, we have a very secure automated retail machine. We're able to age verify. We scan a driver's license. It then takes 360 facial recognition for the purchase and matches it to the ID. So the machines really provide an opportunity for safe, affordable, and available ammunition sales.
There is no doubt that foot traffic will increase based on the feedback that we've gotten. And again, we're super excited not only to have it here, but in other locations in Fresh Value as well.
We're really excited about where we're going. We are going to continue to expand here in Alabama. We have a machine slated to go into Oklahoma, Louisiana, Texas. So over the next year, we're looking forward to, seeing these roll out all throughout the South and the Southeast.
Guys, that is 1 second, guys. Boom. I don't know what's going on with my camera, guys. It's what it is. Something's going on with my camera. That is American Rounds, guys, man. One of our good sponsors, man. I don't know what's going on with my camera. It just shut off. I don't know what's going on. But anyways, guys, man, thank you so much for your time, man. Cliff, man, you want to say anything before we get off, your dog?
Nah, man, catch you all next week.
We guys, man, see y'all next week, man. God bless you guys. All right, y'all. Peace.
God give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.